Simply put, most risks in options trading are dependent on whether you're buying or selling options. When buying options, you have a limited and clearly defined risk, since the most that you can lose is the premium that you paid for the option itself. On the other hand, the risks involved when selling options are dependent on whether you're selling an option you already own or whether you're selling an option to speculate, aka short selling. Once you have chosen your position, you'll want to know more about what are you exposing yourself to. So, stay tuned till the very end. Before I get into the details, I have to set the expectations straight. There is extensive literature and dedicated communities whose sole purpose is to analyze all kinds of risks affecting options and trading. They tend to be separated into conceptual types and assessed based on scale, macro and micro level, and manageability. So, instead of getting too technical and theoretical, this video will outline the general types of risks that you'll face depending on the position size that you choose. I'll provide some sources in the video description and invite you to do extensive research for those that apply to your current situation. Let's jump to the good stuff. Suppose you're an option buyer, aka option holder. In that case, you could lose the total amount you paid for the option relatively quickly. That's just part of an option's nature since it is a wasting asset. That is, an asset that declines in value over time and eventually becomes worthless when it expires. You have to deal with the fact that your options may become worthless upon expiration. You must be right about the direction of a price change in the underlying asset, say the price of a stock or index, and also about when such a price change will occur. As an option buyer, you will inevitably lose your entire investment in the option if you neither sell your option in the secondary market nor exercise it before expiration. The impact of this risk depends on how much leverage you use to control a large amount of the underlying asset compared to if you had bought it directly. The greater the amount of leverage, the greater the profit potential on the upside, but also the greater the risk of loss on the downside. Likewise, an option that gets deeper out of the money means a higher chance of losing all or part of your money in that option, especially if you have a shorter time to expiration. Why is that? Because you would need such a high price movement of the underlying asset for the option to become profitable in a short amount of time. Something that becomes much harder to happen as time goes by. Fortunately for you, an option doesn't have to be worthwhile to exercise for you to make a profit. You can make a profit by selling the option before its expiration for more than its original value, even though the option never becomes in the money and makes sense to exercise it. A good example is when the volatility of the underlying asset increases substantially. Other types of risks that are less common but are worth noting are certain option styles have restrictions before the period when they can be exercised. The only means you can profit from this option is to sell it at the current market price in an available secondary market. That means that if a secondary market for such an option is not available during the time when the option is not exercisable, you won't be able to lock a profit from your strategy. This risk will mainly affect traders with positions in European style options or non-standard American options such as capped options or delayed start options. And finally, exercise provision from an option or a regulatory institution can restrain you as a trader from exercising your options at specific times in certain situations. These last risks are more situational and can be minimized by either trading options that are liquid and conventional or trading option strategies that complement each other. And even if everything fails, you'll survive by taking positions that are suitable to the size of your capital. As you can see, the risks associated with option buyers are pretty straightforward. Now, we can find more nuance if you're talking about option sellers. When you sell options, you're betting that the underlying security price will stay below the strike price. If that happens, you get to keep the premium and repeat the whole process. If it doesn't, you're in the hook for any losses above the strike price. Even before you have to deal with an unfavorable market move, as an option seller you have to deal with the fact that you may be assigned an exercise at any time until the expiration. This assumes you sold an American-style option, and it means that you are subject to being assigned an exercise at any time after you sold or written the option. That can happen until the option expires or until you have closed out your position in a closing transaction. For other option styles, you are subject to assignment only when you reach a specific time or price when the option becomes exercisable. Something that can be tricky in this situation is that you may not receive notice of such an assignment until some days after the assignment has occurred. And once you have been assigned an exercise, you may no longer close out your position in a closing buying transaction. That could happen regardless if you receive notice of the assignment or not. On the bright side, that would only happen if the option is in the money and you're at or very close to the expiration date. Plus, most traders usually prefer to close their positions and lock in a profit rather than exercise. Here, the outcome of being assigned an exercise depends on whether you sold a covered or uncovered, aka naked position. Suppose you sold a call that is covered, meaning you own the underlying asset. In that case, you basically sacrifice the opportunity to benefit from an increase in the underlying asset's value above the option price. Plus, you continue to bear the risk of a decline in the value of the same underlying asset. So, not only do you face an opportunity cost, but also the money you realize from selling the underlying asset could be below its current market value. On the other hand, if the option was naked, the outcome would be even worse because the potential loss is unlimited. Why? Because there's no limit on how high an asset can grow, at least theoretically. In a more realistic sense, some events may cause the underlying asset price to rise dramatically. Such events can be a strong market rally or the announcement of a tender offer for an underlying stock. When it is done at a price that is significantly above the current market price, the event will punch you in the face like Mike Tyson. Some countermeasures are to roll over the options contract to the next period for both the covered and uncovered call, and hold the loss on paper until the underlying asset's price becomes favorable. Yet, you can only do a rollover if you have yet to be assigned an exercise. The same logic applies to selling puts, especially the naked ones. The only thing that changes is that now you have to buy the underlying asset at the exercise price, or pay a cash settlement amount that reflects a drop in value of the underlying asset below the exercise price if it is a cash settled put. On a positive note, the maximum potential loss is limited here since an underlying asset cannot have a price below zero. Similarly, the risk of assignment generally occurs only if the underlying asset's market price is below the strike price. So, you can expect to pay more for the underlying asset upon exercise than its then market value. As a naked put seller, you can eliminate your exposure to margin requirements if you deposit cash equal to the option's strike price with your broker. That converts your position to a covered or a cash secure put, to be more specific. With a cash secure put, you're now subject to any additional margin requirements regardless of what happens to the market value of the underlying asset. Plus, you can earn some interest by investing your money in a short-term debt instrument, say a 3-month T-bill. Yet, even with a cash secure put, you're still subject to a risk of loss if the value of the underlying asset declines much more than you expected. As an option seller of either puts or calls, you can limit your maximum potential loss by buying other options on the same underlying asset or acquiring hedging positions in the options market or other markets. This creates a spread option, and the most common type is verticals, where you sell and buy either puts or calls on the same underlying asset but with a different strike price. Otherwise, if you still want to sell only naked options, you may be required to make additional margin payments. Usually, that can happen when the underlying asset's value moves against your expectations. Other cases are if there is a significant change in the volatility, in the liquidity of the underlying asset, or simply by your broker's policies. If you cannot make those payments, your broker may have the right to liquidate all of your options positions and other securities positions with little or no prior notice. Now, the following risk you can face as an option seller of naked positions is more subtle. When you sell an uncovered and unhedged position, you face a higher risk of loss than a short seller on the same underlying asset. Why is that? Because the impact of any price changes in the underlying asset will be magnified in the option's price because all options are leverage positions. After all, you control a large amount of the underlying asset with a small amount of money. While this can lead to significant profits if things go well, it can also lead to major losses if things go wrong. As a brief example, there are 3 investors, Anna, Beth, and Cody, each with $5,000 to invest, anticipates an increase in the market price of iTaco stock, which is currently $50 a share. So, Anna invests her $5,000 in 100 shares of iTaco. Meanwhile, Beth invests $500 in buying an iTaco call with a strike price at $50 and the remaining $4,500 in T-bills. Finally, Cody is a simple guy who invests his entire $5,000 in 10 iTaco calls with a strike price of $50. The calls on iTaco are priced at $5, with 6 months remaining until expiration. The T-bills have an annual rate of 2.25%, meaning that a $4,500 investment will earn almost $51 in interest over 6 months. If the options are profitable, Beth and Cody will sell or exercise immediately before they expire. The following table shows the dollar and percentage profit or loss that each investor would realize on their $5,000 investment, depending on the price of iTaco stock when the option expires. Let's say that the new market price of iTaco shares is $62. Here we can see that if another investor, say Dylan, had sold short 100 shares of iTaco to Anna and received $5,000 in proceeds, Dylan would have lost $1,200. On the other hand, if to receive $5,000 in proceeds, Dylan had written 10 iTaco naked calls with a strike price of $50, he would have lost $7,000 if the market price of iTaco had increased to $62. Finally, you face one common risk with option buyers. If a trading market in an option should become unavailable or you cannot engage in closing transactions, you would still hold a commitment until expiration or assignment. This risk is particularly situational, so we won't cover it this time. Perhaps in another video. Well, dear viewer, we've reached the end of this video. As I've mentioned earlier, risk analysis is extensive. Also, it is very situational that it would be impossible to cover in a single video. However, I hope this list helped you out to become more aware of the risks you'll face as an options trader, depending on your side. In fact, how many of these risks didn't you know? And which ones did you know? Let me know in the comment section. While options trading certainly has risks, these can be managed with a well thought out strategy and suitable position size. So make sure to do your homework first. And always remember, only risk what you can afford to lose.